Hi, I'm Michael Newrock, and welcome to the training lesson Follow the Trend Phar In this lesson, we're going to go over trailing methodologies. There will be more in-depth coverage of this in future lessons, as well as the case studies and examples, as well as the live trades we look at in the webinar. But hopefully, this will give you a good understanding of the basics of of trailing the trade and trailing methodologies available to you with the Profiteer system. When trading trends, the goal is not just to enter the trade at an optimal time, but to profit from the trend FALAP, FALAP, for as long as possible. Now, yes, you can set hard targets, and you can do so in Profiteer, and there's nothing wrong with that. In fact, it's a great way to be able to convert your equity into capital. But what if the trade continues in your intended direction for much longer, not just double or triple the length? Let's say the hard target was 30 pips. Well, what say that that trend moves for over 300 pips. So it's great to get the 30 pips, but you missed out on the potential 300 or more. Because this is a trend following system, then it makes sense to be able to have the option to be able to trail the trade at predetermined points and then with trailing methodologies. And we'll go over that in a second. So rather than settling for conservative risk reward ratios for 1-to-1 or 1-to-2 as hard targets, not that there's anything wrong with that, we're going to use these as a guide to placing high probability targets, at which point we protect and profit by moving stops of our individual trades and locking in profits. Okay, locking in profits should be a mantra that you repeat on a regular basis. It's very, very important to always lock in profits as you go. The market is unpredictable. It can change on a dime. So it's really important to protect yourself by locking in profits as you go. This way we benefit from the trade as the trend continues to move in our desired position to the initial targets, and then we continue to benefit as the trade continues to move in our predicted direction. By locking in profits at predetermined points, if the price moves against us, we still earn our locked in profits. But if the trend continues, we are in a position to lock in potentially considerably more profits. At this stage, we're in a no-lose scenario and we can manage the trade with a suitable trailing strategy. Trades can be executed as one trade or split between two trades if you are able to do that with your broker. Trades can use moving stops at 3 predetermined points to lock in profits, and I use 5 different trailing methodologies, and the trails can be activated immediately or after the first, second, or even third predetermined lock-in point, which is usually what I do. I'll lock in profits at one target, I'll lock in more profits at a second target, and on the third target, I'll have my trailing activated. And from that point on, as the price continues to move in my direction, my stops will move as well in line with the trailing methodology that I've used, thereby locking in more profits. Some of these trades can go for quite a considerable amount of time, a week, 2 weeks, even 3 weeks or longer. So it's fantastic because you don't have to be continually looking for new trades, and you can ride those trades for as long as the market moves in your direction. The longer it goes, the more profits you've locked in. That's the beauty of it. So targets can be set up 1-to-10, 1-to-15, 1-to-25, whatever you choose. They're idealistic in nature. So they really actually hit their ultimate target because that's not the point. The point is to trail the trade for as long as possible. So you don't want to leave money on the table. You want to continue to trail the trade for as long as possible. So they're suggested targets to use as suitable in conjunction with the profit locking targets and trailing. Targets can be different for the first and second parts of a trade. So you could set 1-to-10 your risk reward ratio for your first position and 1-to-25 or 1-to-30 on your second position. Again, it doesn't really matter. What matters is that you are still in the trade for as long as possible. When a counter signal is created in the market, you can either close your trades but you can move your stops to a price that offers a tight trading window, say 10 to 15 pips on a short time frame. And by tightening your stops, you're still in the trade, but you're protecting your equity. If it moves against you, so be it. Your equity will be converted into capital, increasing your account balance. But if it survives that trading window and then moves in your direction, with say another swing in your intended direction, then you're just going to be able to have that opportunity of locking in more profits. So before acting, you need to ascertain how strong the counter signal is to gauge what is an appropriate stop loss tightening, and whether you should even bother with the stop loss, or whether you should, you know, close your trades out. But I think really just even a small stop loss is not going to hurt. If it moves against you, then you're out and you've converted some equity into capital. But if it survives, you could be in line for a lot more pips. That's really the whole name of the game. So if you have two positions, split trades, open, then you have the added benefit of being able to adjust your stops individually. You can be really tight with one position and more liberal with the other. So for example, set one stop at 10 pips and one stop at 20 pips. This way you might get one of the positions taken out, the one with the tighter 10 pip stop, for profit, and then one position can still be active in the trade. And if it moves you in your direction, then you could be up for another 50, 100, 200 pips, and you'll be grateful and that you actually stayed in the trade for longer to be able to capitalize on those extra pips from the continuation of the move. Naturally, this depends on what point in the life cycle of the trade you're at. In one way, the longer the trade's gone, the more profits you have, so you can be more liberal. But at the same time, it may be coming to the end of the trend. So you just need to ascertain it, judge it on a case-by-case basis, and depending on how many indicators have counted against your position. The more you're in profit, the more liberal you can be with tightening of your stops, as long as you're protecting your equity and building your capital by cashing in the pips on one of your trades by enforcing a tight stop. Here's an example of a downward counter signal in which you could have easily been liberal with one of the trades for it to continue on, whether you have one trade or two trades. You can see that not all rules have been fulfilled, and you can see the attack, in other words, the gradient or the angle. So the moving averages are really the prime thing that we look at, as well as the trend follower. Of the trend follower is gentle, so you want to make sure. Well, in this case, you can see the trend follower is gentle, hinting that momentum for the counter move is not strong. So let's have a look. Here you can see that the buy trades were entered with trend and swing trades, and then we had this counter move, but it failed. The moving averages were very, very gentle. They weren't steep at all. And the trend follower as well was very, very gentle. So we had another buy on the trend and swings, and it resulted in another big move. Then again, we had another counter move. We had a technical crossover here, the fast moving average crossing over the slow moving average, the gold or the yellow over the coming below the gray. So we can see another failed move here because it continued to move up and didn't, move back down. As well as that, it's important to look at obviously your higher time frame analysis. Over here, it's saying that it's a very strong upward direction with 6 out of 6 higher time frames pointing up. So there was less chance of a move to the downside than there was of a continuation of the trade. So if you had your stops liberal at this point, then you would have been able to survive that and make considerably more pips in the trade. Here's an example of an upward counter signal. Once again, you can see that you could have easily held your sell positions with the conviction that the pair would likely continue to fall based on the overall trend direction and the strength of the direction of all three higher time frames. And let's have a look. So you can see the sell trend entry, and you can see that this was a failed counter move. Very, very gentle. The slow moving average is very flat, and the fast moving average, the yellow moving average, is is very gentle as well. Again, here another failed counter move with a very gentle incline on the trend follower and a very gentle with incline with the yellow or gold moving average, and again the gray being very, very flat. So again, the overall trend direction was very, very strong with a overall downward direction with 5 of the 6 higher time frames pointing down. So it gave you a good opportunity, good idea to how to handle that trade when you do see a counter move against you. When trading trends, it's important to lock in profits as you go. The following is a conceptual blueprint for the protect and profit strategy I use for either single trades or split trades before the trades are trailed. Okay, so before you start trailing the trade with your chosen trailing methodology, you want to be able to lock in profits at 3 specific points that you can set before the trade is initiated, or even after the trade has been entered. You can adjust your trade assistant to be able to move the stops and lock in profits at those predetermined points. So let's have a look. In this case, this is an example for a 2-position trade, and you move them at the same profit lock points, so at the first targets, second target, and third target. But in this case, I've chosen to move the stops at different levels. Otherwise, there's not a lot of point of having 2 positions. It just gives you the flexibility of being able to be tight and aggressive with one and more liberal with the other. So for example, on the first target, when the trade is in profit by 25 pips, your first profit lock is move stop loss 10 pips from the current price, locking in 15 pips. Okay, that's your first position. And on your second position, when the same trade is in profit by the same 25 pips, in this case, move the stop loss 20 pips from the current price, locking in 5 pips. So if you were trading just one position, you could choose either or customize it to what you feel is appropriate. When the trade is in profit by 50 pips, move stop loss 15 pips from the current price, thereby locking in 35 pips. That's on your first position. And on your second position, when it hits the same target of 50 pips, move your stop loss 30 pips from the current price, locking in 20 pips. So you got 35 pips locked in on your first position, 20 pips locked on your second position. And then when the trade is in profit by 75 pips, start trailing the trade with your selected trailing methodology. In this case, I've suggested the moving average, either the fast or the slow moving average. You can choose and set that appropriately. And on the second position, when it's 75 pips, start trailing the trade with the PSAR or parabolic SAR. Again, we'll look at lots and lots of different examples, so you'll pick this up really quickly and be able to instinctively know what to do as far as your profit locking is concerned. So the 5 trailing methodologies that I use are, and that are available in the Profitare Trade Assistant are simple trail, 50% trail, the PSAR or parabolic SAR, the moving average trail, and the candlestick trail. So we'll just go over the basics here. More information is available on these trailing methodologies in the quick reference guides and also in the user guide. So make sure that you look at that. The simple trail moves the stop loss without delay, pip for pip. So in the previous example, on that third target, when trailing is activated, if you selected simple trail, at 75 pips was that third target, it would then move pip by pip. If the price moved to 76 pips in profit, then the stop would move another pip. If it moves up again, it'll move another pip, pip for pip. And you can set the trail, how much it's trailing by, in your trade assistant as well. So for example, at 75 pips, it's going to trail the trade 20 pips behind the current price. Every time the price moves in your favor, then it's going to move in line with that pip for pip. The 50% trail ratchets the stop loss up by half the trailing value setting. So for example, if the trailing value is 20, after the trail activation target is reached, say when the price reaches at 124.20, the stop loss, the trailing is activated and the stop loss is set to 124, 20 pips from the current market price. When it gets to 124.30, then the stop loss is moved to 124.10. When it moves to 124.40, stop loss is moved to 124.20. When it moves to 124.50, it moves to 124.30, and so on. So what it does is every time the price moves by a value of 20 in this case, then, well, actually, every time the price moves half of the value of 20, then the trailing stop is moved 20 pips from that current price. Okay, so pip for pip, the simple trailing and 50% trailing are fairly simplistic trailing methodologies. We've included them in Profiteer, but personally, I use the moving averages and the parabolic SAR primarily, and occasionally I'll use the candlestick, which we'll take a look at shortly. But it's great to have all of these options available, and different trades will lend themselves to different trailing methodologies being appropriate. The parabolic SAR trail uses PSAR dots as the trailing value. So let's have a look. For example, with a long trade, as each successive dot plots at a higher price, the stop is moved to the location of the dot. So here's an example of trailing with the PSAR for a long buy trade. So let's say you're in a long buy trade, then the trade will stay in play until price comes back and hits the parabolic SAR or goes beyond that parabolic SAR. Now, every trade is different. In some cases, the parabolic SAR is trailing more closely. In others, it's trailing more further away. And I would typically use the parabolic SAR in my second position where I'm wanting to be a little bit more liberal and allow that trade room to move so it can potentially move a lot further over the long term. And here's an example of trailing with the PSAR for a short sell trade. As you can see, the PSAR trail is quite slow moving, but has the benefit of allowing the trade to continue for a considerable time, which equates to big gains. In this case, it would have only been exited out on this bar when it came up to the parabolic SAR dot. Okay. The nice thing is that you can actually trail the trade a few pips above the parabolic SAR on a sell or a few pips below the parabolic SAR on a buy, and that just gives it even more room. But again, it's on a case-by-case basis, and the nice thing is that you can change the settings at any time in the trade, and the trade assistant will pick it up and be able to manage your trade for you based on your settings. The moving average trail, one of my favorites, using a moving average line as the trail value. You can use either the fast moving average, that's the yellow or gold moving average, and the gray moving average, which is slow moving average. As the line moves closer to current price, the stop trails with it. Again, you can position your trade below that moving average on a buy or above that moving average on a sell if you want to give it a little more room. When using this method, use the moving averages as your guide. So on buy trades, use the lower moving average as your trail, and on sell trades, use the upper moving average as your trail. So you can use the fast moving average. So that would be the gold moving average. But it's your choice at the end of the day, depending on how tight you want to make it or how liberal you want to be with your trailing. So here's an example of trailing with the moving averages on a long buy trade. So in this case, you would have exited the trade when price came below the gray moving average, which is the slow moving average. And here's an example of trailing with the moving averages on a short sell trade. So if you were using the slow moving average, then you would exit the trade. In this case, if you took a sell up here, you would have closed out for profit when this bar crossed over this slow moving average. Okay, so again, it allows you to make some good pips on your trade. The candlestick trail works by moving the stop loss up or down with each successive bar in the same direction. If you're in a buy trade, the theory is that as long as each successive bar is a long candle, the trail would keep moving up. In this system, a long buy trade is activated with two consecutive candlesticks that are both upward candles. And again, you can customize this to have your price below the lows of candles on a buy trade or above at a preset point. It also allows you to adjust the consecutive number of candlesticks before it's activated. So in this case, when this occurs, the stop loss will be moved to the low of the second last closed candlestick for a buy trade. So let's have a look at an example in a moment. Conversely, for a short trade, after trailing is activated with two consecutive downward candlesticks, the stop loss will be moved to the high of the second last closed candle. You can even manage your trades more liberally by keeping your stops a few pips below or above the last candle, depending on whether it's a long or a short trade. So here's an example of a candlestick trail for a long buy trade. You can see that stop loss, okay, will be moved to the low of the candle every time there's a consecutive candle in your direction. Here we can see that price wouldn't have actually been taken out until this bar here, this white bar, where price went below the last stop loss point, which would have been here. And again, there's more information in the user guide and the quick reference guide that may explain it, and will give you some more guidance on how to use these trailings. Naturally, you can only profit from what the market gives. Sometimes it's a lot, sometimes it's just a little. So it depends on the opportunities you sees, but I trust you can see how much more return you can generate from your trades by trailing them effectively. Again, there's nothing wrong with hard targets, but it is nice to be able to trail the trade for as long as you possibly can. And even then, there's no guarantee. You might still get taken out with the spike against you, but the times that you do survive any counter moves and are able to or are successful in trailing the trade for much further than you normally stay in a trade. I'm confident that once that happens, you'll see the real value and the real benefit in being able to trail the trade for as long as possible, rather than leaving money on the table and taking your profits early. Now, look, in some cases, it works out better on hard targets or shorter profits. However, once again, this is a trend following system. So in the profiteer system, typically we're looking for trades that are going to move considerable amount of pips, and therefore trailing the trade makes a lot of sense. So once again, there's a lot of information available on trailing methodologies and download guides and the user guide and the quick reference guide. Under this video, you can download the video so you can watch it again, or just watch it again via the members area here. You can download a special report that accompanies this lesson. There's a couple of tasks for you that you can undertake just to understand it all a bit better. I've got some FAQs under this lesson as well, and of course a link to the area in the forum where we'll be covering trailing methodologies. So I welcome you to upload any examples, and we can have a look at them all on a case-by-case basis. Of course, the Trade Assistant handles all of this. It's just a matter of setting it or adjusting the settings appropriately for each trade. Most trades you'll be able to use the presets that we provide, but it is just great to be able to customize these trades to your personal preferences. So thanks for watching, and this is the last lesson in Module 1. Congratulations. Until next time, good trading, live well, and I'll see you soon.